Being here in this weird YouTube space, I get a lot of questions about dividends. And I get one hell of a lot of recommendations. Paul, have you seen this dividend stock? It's got a great high yield. If I'm honest, a lot of the new stocks that I get now come from you in the comments. And I've noticed on here and on the Discord sometimes that yield is king. And a lot of people seem to buy these stocks simply because they're generating quite high cash flow. I'm brand new to investing and I've started a dividend reinvestment portfolio on Trading 212. The majority of the stocks that I have in this portfolio pay me a dividend. They pay me some sort of passive income. Any that don't, I expect to pay within the next 4 or 5 years. I use this YouTube channel as a week by week example of how a dividend reinvestment and a dividend growth portfolio works. And I hope that in 5 to 10 years I can show that this was a reasonable strategy to follow like it has been in the past, or in fact, value investing is completely dead. I'm told that very often, almost too often. So today I'm going to discuss a couple of mistakes new investors make when trying to build a dividend reinvestment portfolio. I'm going to have a quick look at some of the dividend stocks that I'm currently holding. And finally, as quite heavily requested, I'm going to show you my dividend income from the month of September.
The sucker's going up.
Welcome back everyone, my name's Paul. Now, one of the first mistakes I see people making when they're buying dividend companies is they think that high yield is best. Of course, high dividend yields can be great. Who doesn't want to be given a load of money for very little cost? There's nothing like that warm safety where you sit and wait and accumulate all that stock. But of course, that's only if the dividend is safe, because dividends are not guaranteed. High yield should mean high warning, and it should be a reason for you to delve a little bit further into a company's financials to figure out if they can actually pay for that hefty dividend. What we really want to know is how much cash is being paid out versus how much cash is coming in. Now there's the long way of doing this by going into a company's balance sheet, looking at how much free cash flow they've got, looking at how much debt they've got, and then finally looking at how much they're paying out to shareholders. And if the amount that's being paid out is a very small part of a company's free cash flow, then you might consider that this company has enough free cash flow to pay back to its shareholders at the same time as reinvesting back into the company into things like research and development. The case when you need to be worried is when a company is paying out too much money back to its shareholders and it's not keeping any back for a rainy day, or it's not reinvesting that money back into the company. Now, I pay a monthly subscription to FastGraphs, so I don't need to go into the balance sheets for that. I obviously do read 10Ks when I'm buying into a company or when I'm doing my yearly review, but when I'm doing my initial screening for a company, I'll use FastGraphs and I'll have a look at the payout ratios and the dividend ratios there. And Bristol Myers Squibb is a really good example of a company that is paying out a lot in its dividend. It has a low dividend free cash flow ratio, and it also seems to be increasing its free cash flow quite considerably year on year. Bristol Myers has a relatively low debt to equity ratio coupled by quite a low dividend payout ratio of around 25 to 30%. And over the years, that dividend payout ratio to free cash flow has been getting a lot smaller. And that's one of the many reasons why this week Bristol Myers Squibb is the only stock that I've bought. Another problem I see often with dividend stocks is that dividend stocks just have to be boring. A lot of people say to me, "Oh, Paul, I'm going to buy this stock because it's a great, safe stock. It's been around for years." If I'm honest, I don't think I'm about that. Some of the stocks that I buy, I do buy them because they're nice swan stocks. Sleep well at night. But you don't need to buy boring companies that aren't interested in research and development. In the same way, you don't need to buy super exciting companies which barely have any cash and are unlikely to be around in 10 years. This is where the value investing side comes into dividend growth investing. It's a lot more than just picking a yield and boring stock and just trying to let that grow quietly over the next few years. Stocks like Broadcom, Digital Realty Trust, KLA are all in that really cool semiconductor space. These three companies are going to be a big part of the future of society by generating huge cash flow from AI, semiconductors, mobile devices, and data storage. Medtronic is in that autonomous surgical space. And even Tyson Foods, which is a low-moat meat packing stock which is very controversial, has a lot of exciting ventures into the lab-grown meat. Personally, I think lab-grown meat is one of the biggest innovation disruptors that Cathie Wood has missed out on, and I think there's lots of opportunity in this space. Even Jane Goodall, remember her, the monkey woman? She's currently narrating a documentary about a company called Upside Foods. And Upside Foods just happens to be the new name of a company that used to be called Memphis Meats, which Tyson Foods has huge ventures into, along with quite a lot of new venture capitals that can all make the world of meat much healthier and much safer for the environment. It's a dividend stock and it's actually in exciting places. And another one that I've seen quite a lot recently is that dividend stocks are safe. There were a lot of people getting in on the end of the big rush of 2020 and getting late into stocks like Tesla, Square, Teladoc, Peloton and Zoom. These were all amazing investments, and everything with the exception of Peloton are probably going to be a pretty good investment going forward in the future. But because these people have been seriously burned, sometimes losing 50% on one stock, they've now seemed to decide to move over to dividend stocks and value stocks, thinking that they're going to be just as safe. This is generally a terrible idea. It doesn't matter if you're in growth stocks or value stocks. The problem with investors is that they keep moving around. They keep changing their process. If you stick with the one process, whether it's growth stocks, dividend stocks, value stocks, YOLO stocks, you're probably going to do a lot better if you just do nothing rather than moving around trying to follow the trends all the time. And we can take a look at AT&T, which was one of my riskier stocks. It grows its free cash flow and its earnings quite regularly, but very, very slowly. But it also takes on a lot of debt, and this has scared shareholders, rightly so, because they have decided to cut their dividend. But AT&T does have a possible 70% upside if you follow a value investing model. The truth is, though, this company is about to spin off its growth side of its business and also cut its dividend. So this company is in no way safe. If you're buying into AT&T, even right now at these great valuations, expect AT&T to still do terribly for at least 5 years. We're looking at long-term pain for maybe a little bit of long-term gain. But my point is, while I have done very well here with dividend growth stocks, I did get in at a very important time in the markets after that big drop in 2020, when pretty much anyone could put any money anywhere and still make a lot of money. That test of time has already come for a few of those high flyers during 2020, and now it might be time for those reopening stocks to take their hit as well. But I cannot avoid how good passive income makes me feel. What's most important when considering a dividend reinvestment strategy is that you're not giving up a lot of capital gain just for that high yield. The companies that you buy still have to be really exciting, they still have to be generating high cash flow, and they still need to be reinvesting for the future. The truth about dividend growth investing isn't that you make a lot of money from your dividends, it's that there's a correlation between the dividend growth of a company and the capital gain of a company. If you're into a dividend reinvestment strategy, most of your personal gains are not going to come from the dividends themselves. We're always looking towards that capital gain, it's just historically dividend companies have done really well at this. But in spite of all of that, I've got to admit, I really like how passive income feels. I love that every month these companies pay me money. And in the month of September, I had a great month. We started off with £4.48 from KLA and a little £1 from Visa. 9th of September, pharma company Johnson & Johnson, followed by the 13th of September, Microsoft getting in there with £2.44. I really should put a lot more in Microsoft, to be honest with you. And £6.30 in Raytheon Technologies, a company that isn't making a lot of money right now. 15th of September, £1.85 from 3M. And on the 21st of September, a great little dividend of £9.77 from Tyson Foods. And then on the 23rd of September, another half-year payment from Legal & General Group of £27.93. Now, Legal & General pays its dividend out twice a year. It pays one big one earlier in the year, and then it pays a little one later in the year. And this one is the little one. But Legal & General does have that great dividend yield of 6.16%. But there's no real reason to avoid Legal & General just because it's got a high yield. Forecasting forward, Legal & General's normal PE is around 13 times earnings. And with that in mind, we do look at a 15% upside over the next 5 years. But even if it does a little bit worse than that and we lose all of the gains because the market just doesn't like it anymore and it decides to contract its PE ratio, we still basically, because of that dividend, get a really good return. Then September the 28th, we had a little one of £3.78 from Segro, one of my favourite little REITs that we've got here in the UK. And then a big old special dividend from Rio Tinto at £39.01. And a little normal dividend of £19.19 from Rio Tinto again. This is because Rio Tinto has had a great time with iron ore prices in China at the moment, but that is not likely to stay. When looking at Rio Tinto, we need to consider iron ore prices. China has now opened up and it's done very well for the recent price of Rio Tinto, but in long term it's invested a lot of its cash into new iron ore products and new copper products, and if these two commodities come down quite heavily, it does throw off their projections a little bit. Going forward with Rio Tinto, it doesn't look like a stock I'd be willing to buy right now. It does have a possible bit of wiggle room with a 4% year-on-year growth projection, but most of that is this dividend, and we don't know how well this dividend is going to pay out in the future. And that's everything from September. In September, I earned £121.04. That's the biggest dividend month that I've had so far. In my opinion, this is really starting to show at these very, very early stages how compounding works and how in the long term this income could grow as long as I keep on putting money in and I keep putting money into companies with high cash flow generation. I don't expect next month to be higher, but when I do see numbers like this, when I do realize I'm hitting all-time highs with my dividend yield, this yield at all-time highs does give me that inspiration. It keeps me very involved in investing, which is the most important thing. Thank you very much for watching, guys. If you enjoyed this video, please feel free to like, subscribe, and invest. Wow. The weird things you do in your hotel room on your own.